All right, let's pull back the curtain on one of the most powerful and often invisible forces shaping our cities. We're talking about the financial engine that builds skyscrapers, finances shopping malls, and basically underpins the entire commercial real estate world. This is the architecture of commercial mortgage-backed securities.
I mean, really think about it. That giant, gleaming office tower downtown, the sprawling mall on the edge of the city, who actually holds the loan on that? You might think it's just one big bank, but the truth is so much more interesting. It's a hidden global network. That mortgage has been sliced and diced and is now owned by investors all over the world.
And the tool that makes all of this possible is the Commercial Mortgage-Backed Security, or CMBS for short. So what is it? At its heart, it's a really clever piece of financial engineering. It takes a whole bunch of separate commercial mortgages, bundles them together into one giant pool, and then sells off little pieces of that pool to investors as bonds. It turns a clunky, illiquid loan into something you can trade almost as easily as a stock.
So how does this whole thing actually work? Well, we're going to follow the money. We'll start with a single loan on a single building and track its journey to Wall Street. We'll look at the assembly line that builds these things, see how they carve up the risk, understand why a borrower would even want one of these loans, and then look at the wild boom and bust cycle of this market.
Okay, so let's make this tangible. Imagine a real estate developer just put the finishing touches on a brand new 200-unit apartment building. They need a big loan. Now, instead of walking into their local bank, they go to a very specific type of lender, often called a conduit lender. You could think of these guys as the first stop on the assembly line. Their whole business model is to make loans that are designed from day one to be packaged up and sold. So our loans journey begins right here.
Right, so that one loan for our apartment building, it's a big deal for the developer, but on its own, it's not nearly big enough to attract global investors. It needs to be combined with others, and this is where the magic of the CMBS assembly line really kicks in, the process that takes that one local loan and turns it into a tiny piece of a massive, globally traded security.
And here's that process, broken down into 5 key steps. First, origination. That's our apartment loan getting made. Simple enough. Second, pooling. Our loan gets bundled together with, say, 100 other loans, an office building in Chicago, a hotel in Miami, a warehouse in Dallas, to create a diverse mix. Third, securitization. This whole giant pool of loans is put into a special legal trust, and that trust issues bonds. Now, these bonds are backed by all the mortgage payments flowing in. Fourth, and this is the absolute key, tranching. Those bonds are sliced up into different layers of risk and reward. And finally, number 5, distribution. The big investment banks take these brand new bonds and sell them to investors all over the globe.
Okay, let's zoom in on that slicing process we just mentioned, tranching. Because this, right here, is the secret sauce. It's how you can take one big pool of loans and create a whole menu of different investments, perfect for everyone from your ultra-cautious pension fund to a high-risk hedge fund. And the best way to picture how this works is to think of it as a financial waterfall. So imagine all the monthly mortgage payments from those 100-plus properties are all flowing into one giant bucket at the top. That money then cascades down, paying off the bond investors in a very strict predetermined order. But what if a few borrowers stop paying and the water level starts to drop? Well, the investors at the very bottom of that waterfall are the first to get hit. They feel the pain of any losses first. This waterfall structure creates these really distinct tiers. Up at the top, you have the senior tranches. They're usually rated AAA, they get paid first, no matter what. That makes them incredibly safe, which of course means they offer the lowest return. In the middle, you've got the mezzanine tranches, a little more risk, a little more reward. And then all the way at the bottom, you have the junior pieces. These guys are the first loss position. They only get paid after everyone else is paid in full. So if anything goes wrong, they get wiped out first. To get investors to take on that kind of risk, you have to offer them the highest potential returns. So who's actually buying these different slices? Well, that huge safe chunk at the top, the senior tranches, that's perfect for big conservative institutions like insurance companies and pension funds. You know, the people managing your retirement money. But that small 10% high-risk slice at the bottom? That's where the hedge funds and the specialized private equity firms come to play. They're often called B-piece buyers, and they are perfectly happy to take that first loss risk in exchange for a shot at massive returns. Okay, so that all makes sense from an investor's point of view. But let's go back to our apartment building owner. Why would they choose this incredibly complex path instead of just getting a normal loan from a bank down the street? Well, it all comes down to a very specific set of trade-offs. The biggest advantage, the grand prize, really,
is that CMBS loans are almost always non-recourse, and this is a huge deal. It means that if the property goes under, the lender can take the building, but they can't come after the borrower's other personal assets. It's a massive layer of protection. But the price you pay for that protection is extreme rigidity. The loan is like a contract set in stone. It's incredibly hard to change, because you'd literally have to get hundreds of different bondholders around the world to agree to it.
Yeah, the difference really boils down to this. Is it a relationship or is it a transaction? A traditional loan from your local bank is relationship-based. If you run into trouble, you can call your banker and try to work something out. A CMBS loan? Purely transactional. If you default, your loan gets kicked over to something called a special servicer, and their only job, their only legal obligation, is to get the bondholder's money back. They're not there to be your friend. It's a much colder, much more rules-based world.
So why does any of this matter to the rest of us? Because this market is a gigantic source of money for commercial real estate, and its health, or lack thereof, has massive ripple effects across the whole economy. When the CMBS market is humming, cranes dot the skyline. When it freezes up, construction stops, jobs are lost, and you start to see a lot more empty storefronts. And believe me, its history has been a complete roller coaster.
In the years leading up to 2008, the CMBS market was absolutely on fire. Lending standards got looser and looser. Then, of course, the global financial crisis hit, and the entire system just seized up overnight. After that crash, we entered a new era called CMBS 2.0, with a bunch of reforms to try and make things safer. But new challenges are always popping up, like the market freeze during COVID and the so-called wall of maturities everyone is talking about now.
And if you want a perfect picture of that crash, just look at this chart. It is staggering. In 2007, the market pumped out $230 billion in new securities. Just 2 years later, in 2009, that number had collapsed by more than 95%. The entire fire hose of capital for commercial buildings was just shut off.
So, to rebuild trust and get the market working again, regulators brought in CMBS 2.0. And the single most important reform was something called risk retention. It forced the companies that packaged these loans to hold on to 5% of the deal themselves, to have skin in the game. And the logic here is pretty simple, right? If you're forced to eat your own cooking, you're going to be a heck of a lot more careful about the ingredients you use.
Okay, so let's bring this all home. After looking at the mechanics, the trade-offs, the crazy history, who is this type of financing actually for? Because it is definitely not for everyone.
CMBS financing is pretty much perfect for a very specific profile. The owner of a stable, high-quality, fully leased building who plans to hold on to it for a long time, and who values that non-recourse protection above everything else. It is a terrible, terrible fit for someone buying a fixer-upper property that needs a lot of work, or for anyone who needs flexibility or might want to sell in a year or two. It's a powerful tool, but you've got to use it for the right job.
And that really brings us right up to today. With remote work totally changing the game for office buildings and a whole new interest rate environment, the CMBS market is at another one of those fascinating inflection points. The complex architecture that we've just walked through is going to be what determines how well these buildings, and by extension our cities, can adapt to whatever comes next.